Manpreet Gill, senior investment strategist at Standard Chartered. I must add also an MBA of INSEAD, so again a very good MBA indeed. So a very qualified person to give us investment advice. Now, first of all, your advice, Manpreet, if you can, to investors who are very nervous that this has been on for 2 years. Once again, they're locked in talks. Once again, there's no resolution. And once again, there are so many elements and parts. And the Dutch, particularly this time, are saying, we're not actually convinced. How worried are we?
Well, the whole thing doesn't really come as a surprise. I wouldn't really use the word worry, but I think in our view, you really do need to factor the uncertainty into your investment decisions. We are today nearer a solution to the imminent issue at hand, which is how is Greece going to make payments when the next redemptions come due in March. So while some of the near-term problems are definitely solved, you can't really go out and say that we've solved the whole Eurozone debt crisis and this won't come back to bother us again. These issues will sort of still simmer over time. There's no ruling out the fact that the concerns may not come back, and we believe that a suitable investment strategy in this environment has to reflect that reality, both in terms of arguably being tactical, but also in terms of thinking about what risks specifically you're taking.
Now, if it wasn't for the central banks pumping money into this again, you would have a bit of a problem, wouldn't you? A pretty big problem.
Well, no, central banks pumping in is arguably good for investors in the short term. I mean, if you think about the rally that we've seen recently, arguably a large part of it has been driven by the fact that central banks have been pumping, a large amount of liquidity into the system. We've seen, the market reaction after the Fed did QE now at least a couple of times, and we're seeing again with the ECB. This is a reality, and the fact is that risky assets will do well in these kind of environments. However, the fact also is that, that doesn't take away some of the core risks. So we believe an investment strategy has to incorporate the fact that you need to be long some risky assets, specifically the ones that help you manage your volatility but also help you get paid. But it's not a situation where you sort of go out and try and get as much beta as you can. We do not think that would be the right approach.
When you gathered your team at the beginning of this year, looking ahead to asset allocation, your neutral equities, you've got overweight stance on gold, for example, you like corporate credits again. Which asset class do you favour as taking a little bit of risk but also being fairly safe through the storm of 2012?
Well, that space, I mean, my favorite one would be corporate credit. This is an asset class that sort of fits our sort of, ticks all the boxes in terms of what would do well in this kind of environment while providing adequate protection. If you take, Asian high yield credit, for example, there's a lot of evidence that this asset class does well in the kind of muddled through risk on risk off environment that we're in right now, but also does fairly well if we end up getting surprised by growth, or if, things do surprise us on downside and the situation gets worse. It helps you manage your volatility of your investment portfolio, but the coupons and what we think are unusually high yields still at the moment ensure that you get paid at the end of the day. So in this kind of environment, while it makes sense to have equities in a portfolio, it makes sense to have commodities in a portfolio, we think corporate credit, high yield but also investment grade, fits the bill arguably better than a lot of other asset classes.
And when it comes to equities, Manpreet, do you feel that it's best to go defensive? I mean, looking also across the emerging markets of Asia, does India offer the best opportunity right now or not?
Well, India, we expect, will perform in line with the region. So we see a rise in invest appetite for Asian emerging markets. India should do well. But our top pick in this region continues to be Chinese equities. And the reason for that is that on a relative basis within the region, it fits a lot of the characteristics common to other markets in the sense that, we see a risk-on rally. Yes, Chinese equities should do well. But the valuation story is much, much more compelling. So in that sense, you protect your downside risk to a larger extent than you do elsewhere. And in addition to that, you also get to play on what's happening domestically in China. I mean, a lot of bad news has been priced in over the past couple of years with the policy tightening, with the real estate measures, and we think that on the margin, policy, is going to ease slightly, and we think, that will provide an additional boost to Chinese equity markets. So when you combine those factors, we think that's the market where the story is most compelling in the Asian region.
Manpreet Gill, many thanks for your time. You're going to have a very good week indeed.